Okay, so the market spent July on a sugar high, Christine, as the economy limped along. That's according to PIMCO's co-CEO Mohamed El-Erian. Joining us with her thoughts, Emily Sanders, the CEO of Sanders Financial Management, enjoying a bit of a holiday over here at the Beatles Museum. I hope that was good.
It was wonderful.
Is it rock and roll for the stock markets now? Are we sort of just got over? Are we on this sugar high that Mohamed El-Erian talks about?
I agree, Ross, with Mohamed El-Erian's comments yesterday about the sugar high on U.S. Squawk Box. You know, right now the major market indices are about halfway between the October 2007 highs and the March 6, 2009 lows. And we believe there's going to be a W-shaped recovery, particularly in the equity markets. And we're now on the top end of the second part of the W.
Top of the middle part of the W.
Yes, and we're looking for an 11% retracement of the Dow and the S&P back to
That's
about...
pretty exact.
Well, looking for about 8,000, back to 8,000 on the Dow, which those levels were reached earlier this year in the second quarter, and about the high 800s in the S&P.
Emily, it's Bertha here in the States. How troubling is what seems to be a lack of appetite for these huge bond issuances? We're very early on in. You know, we've got another one today, and next week we've got 3, 10, and 30-year. Yes,
it is troubling. It's not extremely troubling, but when you think that the U.S. is on track for a $1.84 trillion deficit by the end of its fiscal year, that's pretty troubling, because that's close to the amount of the foreign exchange reserves held by China. So when you think of it that way, and you know the rates are edging up, it does look like inflation is a little closer than the Fed would lead one to believe.
And Emily, Christine here, what does that mean for the dollar?
Well, we believe that the dollar is in a secular downtrend, and you know it's had some strength this year because it really still is the world's reserve currency. About 65% of the world's foreign exchange, according to the IMF, is made up of the U.S. dollar. But we believe that over time there will be a tripartite global currency that will consist of the U.S. dollar, the Chinese yuan, which of course the Chinese are making movements to have that happen, you know, over the next decade, and the euro, or some form of, you know, European currency.
Okay, Emily, you're gonna stick around with us for the next 45 minutes or so. Emily Sanders, CEO of Sanders Financial Management.
Now, joining us is Doug Roberts. He's the founder and chief investment strategist at channelcapitalresearch.com. And still with us is Emily Sanders, the CEO of Sanders Financial Management. She is our guest host this hour. I want to start with you, Doug. You know, Mohamed El-Erian yesterday on U.S. Squawk Box says he feels like the July rally has been a bit of a sugar high. Feels like we're starting to feel a little bit of the sugar low. The mood seems to be turning a little more glum with these auctions not going so well as far as debt offerings, and a lot of folks thinking, yes, we're stabilizing, but maybe the recovery is going to be pretty darn weak. What's your thought?
My thought is right now what you're experiencing is somewhat of a rally from where we were. It's almost like if you pull a beach ball down far enough below the water, you're going to have a fairly violent uptick as it pops to the surface. That's what we're experiencing now. I think it's going to continue for a while. I said this a couple of months ago that I think the S&P could probably hit 1,000 or more, and I'm still sticking to that, simply because right now it's a question of earnings and expectations. The earnings are coming into a series of easy compares. The market seems to be accepting cost cuts as a valid way of dealing with earnings growth. They're kind of dismissing the revenue growth aspect of it for the future. And so as a result of that, if you don't have any economic landmines, you're going to have this back and forth. But as long as there's nothing major, you'll probably continue to drift up. But the real question is what happens when you get past the earnings comparisons. That's where essentially the rubber hits the pavement. And then it's a little bit more glum, because even if you look at it, everybody's saying that really a bull market begins prior to the end of the recession. There was one important exception to that situation, and that was in 2001. The recession ended in November, and we had a fairly spectacular bounce, but then reality set in 2002, and until really the employment situation starts to stabilize, it's going to be very, very difficult to maintain anything more than, let's say, an advance from the 1,000 to, let's say, 1,100 range, because after that, people are going to wonder what you're doing for an encore.
Well, that's a sobering outlook. Emily, are you in that camp? Do you see things getting quite that bad? Could we actually have a down year?
We do believe that the year will end up, but in the meantime, we're going to retrace half of the gains that we made, which was pretty much a gift since March 6th. You know, the market average is up 30, 40% since March 6th. Really, the gains are going on air, on fluff, and as Mohammed calls them, sugar high. If you look at the fundamentals, housing still hasn't hit a bottom despite the most recent Case-Shiller numbers. Unemployment will probably hit 11% in the U.S. People who are unemployed aren't consuming. And therefore, we believe that, and agree with Doug Roberts, that once the numbers actually settle in and the easy earnings comparisons are behind us, we'll see that there'll be a second leg down, probably about 11% in the Dow and S&P before things start going up again in somewhat of an L-shaped or L-shaped economic recovery.
Yeah, and I wonder, Doug, and I'll put this to you, whether there's something actually just more base going on here than earnings beating expectations. I wonder if we're now in a stage where if you're a fund manager and you benchmark yourself and you haven't participated in this rally, there must be a lot of guys under a lot of pressure from their clients to say, why aren't you making me money in this rally? And is that going to pull more money in and perhaps take us higher than we think we can go?
Absolutely. I agree with you totally on that, Ross. It's what I call performance anxiety. Essentially, it could result in a melt-up in the market because you figure most people last year lost money. It was really the degree of money they lost. A lot of their investors, especially on the long side, will not be particularly tolerant if they're lagging in the benchmark or they're in negative territory or flat territory, and the market will be on the way up. So more and more as you start to do it, it becomes like a self-fulfilling form of momentum. People have to shadow their benchmarks. They have to be into the market. And that's why I'm saying you could go quite high. You could go to 1,100 on this. And then really what it's going to be dependent upon next year is what I think Emily was talking about before, is can the stimulus that we're talking about or that we've discussed actually offset this consumer spending? And that's a very, very iffy thing at this point. China has the reserves to do it. I'm not quite sure the United States is in the financial position that China is to stimulate the economy.
Hey, Doug, this is Christine. So in the meantime, what do you do with your money? Do you take profits now and then jump in later?
I'd say at this point you let the rally go. What you really have to do is look and kind of divide your portfolio into various buckets. Number one is you should really make sure that for the next year to 2 years or even several years, if you have major financial obligations, you have the cash to pay for it, and I'd be quite conservative with that bucket. You could have another bucket that's more of a trading bucket that, you know, you're looking to really trade this rally in some way. And I think it probably, after an initial pullback, probably has some ways to go on this. But then at that point, you really have to look long term and then say, is this money that you need for a while? And with that, I'd be a bit more cautious on, I guess the name of the game is asset allocation and then making sure that you're not overextended in this type of a market, because what we're getting today can be taken away in a year quite easily.
Yeah, and Emily, what's your thoughts here? Because I look at your notes, right, and you go US stock market in a bear market, potentially secular, US Treasury market entering a bear market, US dollar, secular bear market against emerging market currencies. Doesn't leave a lot else, and commodities, yeah or no?
Well, commodities will benefit if the dollar continues its secular weakness, and we do have most of our clients invested in some form of gold through an ETF, gold bullion. However, we really like corporate bonds. Right. Those are a great alternative to cash
Despite
right now.
That they've been, what, the best performing asset, I guess, this year, asset class?
Well, they have, particularly if you look at high yield bonds, which we think are a bit toppy right now. But we like dividend paying stocks. We're not anti-equities at all. We're just more balanced, even for clients that are still actively working and earning a living and not yet retired. We're shifting more toward fixed income for that, steady dividend yield.
Emily, always good to see you. Thanks so much indeed for joining us. Have a safe flight home back to the States tomorrow morning. Emily Sanders, the CEO of Sanders Financial Management.